Good evening, students. Welcome to the session. In the last lecture, we had started with the tax audit. We were going through the different clauses of the tax audit, right? And we had covered till clause 22, isn't it? So, we were going through clause by clause wise with respect to each and every clause, what it requires, the parallel uh, provision which is there under the Income Tax Act, why the reporting is required under this. So, with that note, now we'll start with this particular class. But before we go on to this class, I just wanted somebody to recap in case you can. So, yes, what did we discuss? If somebody can just quickly recap. Yes, what did we discuss in the last class? Yes, Master. What did we discuss in the last class? Yes. What is the requirement for tax audit? What are the limits? Very quick recap. Yes, very good, Sanjay. What are the limits for the tax audit for businesses, for profession? Can you give a recap of that? Yes. 44 AB, yes, that's right. 1 crore, yes, that's correct. Then 3 crore, yes, that's correct. In case of the digital payments or non-cash payments, non-cash expenditure. Yes, what else? For profession, what are the limit? Yes, that's right. 10 crore. Yes, what else? For the profession, what is it? 75 lakh? It's not 75 lakh, isn't it? For profession, what is the limit? It's 50 lakh. Yes or no? It is 50 lakh, not 75 lakh. Yes? For business, it is 1 CR in case the cash receipts, cash payments are less than 5%. Then it is 10 CR. For profession, it is 50 lakh. Then to whom else the tax audit is applicable? Yes. To whom else the tax audit is applicable? For presumptive, what is the rule? Yes. 44 AD exceeds 2 crore? No. For 44 AD, what is the rule for tax audit? I'm not quite sure how. Yes. So in case you are opting for 44 AD and then not offering it up to the 8%, 6% for any of the 5 years, and your total income exceeds the basic exemption limit, yes or no, then in that case you are required to undertake tax audit. So that is when you attract section 44 AD subsection 4. What is the requirement under 44 ADA? When you do not comply with the limit of the 44 ADA, which is 50%, when you offer less than that, isn't it? When you offer less than that, then in that particular case, and if your total income exceeds the basic exemption limit, then in that particular case, you are required to undertake the tax audit. Yes or no? So this is what are the limits for the tax audit that we discussed. Yes? Are we clear, everyone? Okay. Now quickly give me a recap for each and every clause that we have discussed so far. Yes. A quick recap of all the clauses. What was clause number 1? 1, 2, 3, 4 was very simple. What was it? Yes, faster. 1, 2, 3, 4 was a factual exercise. Factual information for the taxpayer, isn't it? Name, address, PAN, Aadhaar, GST registration number. Yes, right. Status. How do you find the GST registration number and all? Whether you are required to confirm that he is required to obtain the registration under any other law, or is it just that you have to put the registration number? What do we have to do in this? Is the tax auditor required to put an opinion that the assessee is required to obtain the registration under so and so law? Yes, he is required, right? So, you need to put appropriately over there that the auditor has to put that he is required to obtain the registration, right? And then he has to just put the registration numbers. Then previous year assessment year, then indicate the relevant clause of 44AB under which the audit has been conducted. Right? So basically, whether you are conducting the audit because your turnover of business is more than 1 crore, 10 crore, or turnover of profession is more than 50 lakh, or is it because you're not offering as per the presumptive section of 44A, B, triple B, or because of 44 ADA, or because of 44 AD, right? Then whether the assessee has opted for the taxation under 115 BA concessional tax regimes. How will you get that information? Yes. How do you get this information? Faster students, we have done all of this in the last class. It's just revision that we are doing. From the last year return of income, from the specific forms filed to opt for these concessional tax regimes, isn't it? Right? And in case you have not yet opted in, then in that case, you have to rely on the representation from the client. You have to rely on the representation from the client. Okay? Then, if the part B is regarding the firm or AOP, indicate the name of the partners, members, and their profit sharing ratio. How do you get this? From the partnership deed, from the AOP deed, any supplementary deeds which are signed in. If there is any change in their ratio, again you need to obtain the supplementary deeds to ascertain that. Yes, very good. Nature of the business or profession, how do you ascertain this? Yes. Nature of the business or profession, MOA, AOA, partnership deed, right? From the business contracts, you will be able to ascertain that. If there is change in the nature of business, the particulars of that change needs to be mentioned. Okay. Whether the books of accounts are prescribed under 44A, if yes, list of books are prescribed. So what did we discuss? For whom the books of accounts are prescribed? For the specified profession under rule 6F. Right? So you need to put the mention of that. And put the list of books of accounts that are maintained and the address at which these are maintained. Okay, in case it is maintained on the computerized system, then on what server it is maintained, you need to put that. And the list of books of accounts and nature of relevant documents which are examined by the tax auditor. Whether the profit or loss includes any profit and gains assessable on presumptive basis, indicate the amount and the relevant section. So what do we have to put it over here? That whether I have included any profit on the presumptive basis. Right? So I need to ascertain the amount of the presumptive profit and put it over here. Method of accounting employed in the previous year. This is very simple, whether it was cash or accrual. Whether there has been any change in the method of accounting vis-a-vis the method employed in the immediately preceding previous year. So you should put about that. What are the reasons of change and what is the effect on profit and loss? Whether any adjustment is required to be made to comply with the provision of the ICDS. So here you have to give the information regarding each and every ICDS. Isn't it? You have to give the information regarding each and every ICDS. Right? So ICDS wise, increase or decrease in the profit and loss and the disclosure as per each and every ICDS needs to be mentioned. Then method of valuation of closing stock. And in case there is deviation from the valuation, you have to prescribe that. Then particulars of the capital asset converted into stock in trade, right? So you have to give the description of the capital asset, what was the date of acquisition, what was the cost of acquisition, amount at which the asset is converted into stock in trade, right? So how do you get this information? In the clause 12, it says amount of profit and gains of business and not the amount on presumptive basis is to be given. What does that imply? So in clause 12, you are asking, right? So here it is asking about whether the profit or loss includes any profit and gains assessable on presumptive basis. So here they are asking you to provide the amount of the profit which is assessable on the presumptive basis. So in the total profit, in the net profit which is prepared as per the financial accounting principle, what is the profit which is assessable on presumptive basis? So the tax auditor needs to state that in clause 12. It is only the amount of profit which is included under the profit and loss account which is covered by presumptive taxation and not the actual amount that you're going to offer as per the presumptive basis. Are we getting this particular point? Okay. Yes, you take 6% or 8% as income. It is not asking about what is 6% or 8%, Sanjay. It is asking about what is included in your P&L, whether it includes any profit which is assessable on presumptive basis. See, when you, let's say for example, if you are a partnership firm and you are following the accounting standards for preparing your financial statement. Now in that you will not include it as for 6% or 8%. You will actually include the presumptive profits. Like you will basically include the actual profits. It may not be actual 6% or 8%. It may be 5%, it may be 10%. So what is the amount that is included in your profits? In your financial statements and not what is actual 6% or 8%. This clause is asking about that. Are we clear, Sanjay? Okay. Yes. So with respect to the clause 15, how do you get the capital asset converted into stock in trade? So you need to look into the balance sheet, whether there has been any conversion of capital asset into stock in trade, any land, any kind of investments, whether they are converted into stock in trade. So you have to find out what is the date of acquisition. So you have to refer to their agreements, the contract notes and all of that to find out what was the date, what was the cost, amount at which the asset is converted into stock in trade, whether it is converted at the fair market value which is required as per section 28, or is it some other value which is there, right? So that all have to be stated over here. Then amount not credited to the P&L account being the items falling within the scope of section 28. We discussed this. What is included in section 28? Duty drawbacks, right? The sale of duty entitlement licenses, then non-compete fees, right? Which are not credited to the P&L. The perquisites which are there, right? So all of that needs to be reported. Escalation claims accepted during the previous year or any other item of income. Capital receipt, if any capital subsidies which are there, right? So that all needs to be reported over here. Then whether any land or building is transferred during the previous year for a consideration less than the stamp duty value. Then you need to report that over here. Then 18 is with respect to the depreciation. So you have to classify under the correct block. What is the actual cost or written down value opening? What is the date of acquisition? What is the cost of acquisition, the actual cost of new asset? And then you have to finally put the rate of depreciation and the depreciation thereon, right? And you have to look at, yes, the fixed asset register. If there are any deductions, if there is any change in the foreign currency exchange because of section 43A, if there are any subsidies or grants, if there is any interest on loan capitalized. So all that you need to put over here. Then 19 is about amount admissible under these section, which are the specific deductions which are given, right? So you need to put the amount with respect to that. Then 20 was any sum paid to an employee as bonus or commission for services rendered where such sum was otherwise payable to him as profits or dividend. Right? Then 20B was detail of contribution with respect to the ESIC PF of the employees, which has been collected and which has been deposited up to the due date, when it is actually deposited, and what was the actual due date. So you need to put everything into this. Then 21 was with respect to the section 37 deductions, right? Yes, very good, Sanjay. It is first considered as income and then allowed as deduction. Under 21, you need to put the amounts with respect to the capital expense, personal expense, advertisement expenditure in any souvenir published by political party, expenditure incurred at any clubs, expenditure for any purpose which is an offense or is prohibited by law, or expenditure by way of penalty or fine or violation of any law, right? Or for compounding of any offense, expenditure to provide any benefit or perquisite which is prohibited under any guidelines, right? So you have to put all these expenses properly. Then amount inadmissible under section 40A1, 40A1A, which is with respect to non-deduction of TDS or deduction but no payment of TDS, right? So again, you have to put over here these particular expenses. Then any salary on which the tax has not been deducted, right? The payment to a unrecognized provident fund, any taxes on the non-monetary perquisites, that you have to put. Then C is the amount of the bonus, salary, commission, remuneration, interest, which is inadmissible under 40B or 40BA for the partnership firm or the AOP or BOI. Then disallowance under section 48.3 or 48.3A. So 48.3 is with respect to the cash payment more than 10,000 other than rule 6DD. 48.3A is that any opening balances of liabilities are there which are now paid in cash. That will be considered as your deemed income. Then payment for provision for any gratuity which is not allowable under 40A7. Right? Any sum paid by an employer which is to the unrecognized provident fund, that is under 40A9, you need reporting. Liabilities of contingent nature, amount of deduction inadmissible under section 14A in respect of the exempt income, amount of any interest on the loan which is for the capital asset which has to be capitalized, that needs to be reported. In 22, we saw amount of interest inadmissible under Section 23 of MSME Act, because if you make the late payment, you are liable to pay the interest under MSME Act, and that interest is not allowable as deduction under the Income Tax Act because it's a penalty. Right? And then in the clause 2, you need to report the total amount which is required to be paid to the micro small enterprise, not medium. And out of which, how much is paid up to the time given under Section 15 and how much of it is not paid up to the time given under Section 15. So we are done till this particular point of clause. Any questions so far? Any doubt? Yes? Any doubts? Any questions? No? Okay. Let us proceed further. Now what is clause 23? Particulars of payment made to persons specified under section 40A2B. What is 40A2B? Yes. What is 40A2B? Yes, faster. What is 40A2B? Yes. Payment to relatives? Yes. It's not payment, it's expenses with respect to the relative or relative, not relatives, it's a related party. Right? So, under 48(2)(b), it covers the certain specified person in respect of individual, any relative of the individual, where it is a company, partnership firm, LLP, AOP, HUF. Then in that case, it is either the director of the company, the partner of the firm or LLP, members of the AOP BOI, relative of the directors or the partners or members, or any individual who has a substantial interest in the business of the assessee, or any relative of the individual who has a substantial interest in the business of the assessee. In case of any company, firm, HUF, AOP, BOI having a substantial interest in the business of the assessee, or in any of their directors or partners which are there, right? In case of a company again or AOP, BOI, right, of which a director has a substantial interest in the business of the assessee. An individual having a substantial interest in the business of the another person. Right, so basically there are certain relationships which are given. In case where a business is carried on by a company, any person owning more than 20% of the voting power. So here, how do you identify first of all this thing? That whether the payments are made to the related parties. Yes, faster. From the audit reports, the agreement, yes, that's right. So you need to first of all ascertain who are the specified persons which are there. You can first check the list of the members register, shareholder register, director list, right? You can obtain easily from the MCA, right? Then you can see any concerns in which these directors are interested, right? Then you can obtain the details of payment made to the specified person. You can look at the specific ledger accounts, right? To see that you can call for any contracts or agreement, right? So on that basis, you can identify. Now, it may be possible that you may not have complete information. So for that, you can rely on the management representation. You can also look at the related party transaction RPT schedule under the financial statements. But the related party definition for under AS 18 is different from 40A to B. So that you have to just keep into consideration. Right? So basis that you just need to report over here the payments made to these person. Okay? Then 24 clause is amount deemed to be the profit and gains under 33AB or 33ABA. What is this? Yes, it's tea, rubber, coffee, site restoration. That's right. But what are these sections? What is the amount deemed to be the income? Yes. What is their income? No, 40% is the deduction, Sanjay. What is this income? Yes, faster. No, that is still the deduction. See, it's not that. I'll tell you what is it. So 33AB, if you remember, requires you to claim the deduction provided you deposit the amount in the NABARD account. Right? Now, if you withdraw the amount from that account, either for certain not specified assets, non-specified utilization, or you do not utilize it, like if you misutilize or if you do not utilize it, right? Then in that particular case, it is deemed to be the income. Do you recollect this? So under 33AB, you have this restrictions on how you can use the amount. So where any amount is utilized, which is withdrawn for the purposes which is not in accordance with the scheme. Are we getting this? Then it will be considered as your income. Yes or no? Or where the asset is sold or transferred before the expiry of the 8 years from which it was acquired. Then also it is considered to be your income. Or where you withdraw the amount from the NABARD account, right? Or it is utilized for any expenditure which is not allowed. Yes, so in that particular case, it will be considered as your income. That is what is required to be reported over here. So now how will the tax auditor verify this? Yes. So the tax auditor will look into the NABARD account and see how the amounts have been verified. Amounts have been utilized, the withdrawn amounts. Plus, in respect of the assets sold, he will see whether they have been transferred before the expiry of the 8 years from the date of acquisition. In that case, the amounts need to be reported over here. Clear? Yes or no? Okay. Clause 25 is any amount of profit chargeable to tax under section 41 and the computation thereof. Now, what is section 41? Remission of what, Sanjay? Yes. Any expenditure allowed as deduction earlier but recovered? No. See, this is with respect to the not expenditure allowed earlier. So, here we are talking about the any income which is there, which is not any income but any amount, any liability for which a deduction has been claimed and now in respect of which a waiver has been obtained. Remission or cessation of any trading liability. Are we getting this particular point? So that is what is covered under 41. So 41, where any deduction is claimed in respect of trading liability and now there is a remission or waiver of that liability, that needs to be reported over here. So this is what this particular clause is asking about. So the auditor should obtain a list of all the amounts chargeable under 41 with the corresponding evidences. He should satisfy himself with the looking at the past records that there was a deduction claim and now there is a profit chargeable to tax. So you need to check whether these amounts have been written back in respect of trading liability. So that is what you have to report under this particular clause in respect of section 41. So you need to see whether there is any remission or cessation of the liability. And this is irrespective of which, whether there is a credit to the P&L or not. Are we clear? Even if the assessee himself has not considered this as income, you will consider it if there is any remission or waiver of any liability under 41. Yes or no? Any questions, any doubt? Okay, next clause is 26, which is talking about in respect of section 43B. Some referred to in 43B, the liability for which pre-existed on the first day of the previous year but was not allowable in the assessment of any preceding previous year and was paid during the previous year or not paid during the previous year. What is this? Yes. No, this is not 10,000 in cash. That is 48.3. This is 43B, Sanjay. This is different. What is this? What is 43B? Contribution to ESIC PF, but what is it exactly? Yes. Not paid as per the respective act? No. No, 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 no. This is incorrect. So 43B allows the deduction on the payment basis, allows the deduction of certain expenditure only on the payment basis. Like for example, interest on loans, your contribution to employer's contribution to provident fund, not the employee contribution, right? These are certain deductions which are allowed on the payment basis. Yes. So, not by the due date of the fund, but by the due date of the return of income. If you pay before the due date of return of income, only then these deductions are allowed to you. Okay. So basically, what here they are trying to say in 26A, they are saying any liability which pre-existed on the first day as an opening balance, but was not allowable in the earlier previous year and is paid during the current previous year. you have to report that. So how will you identify this? So let's say, for example, any liability which is appearing in my opening balance, or even if it is not appearing in my opening balance in books, let's say, for example, yes, it will be appearing in the opening balance of books. Now, if this was paid after the due date of the return of income of the last previous year, so then it will be allowed in the previous year in which it is actually paid, right? So that needs to be reported under 26AA. This will also include the payment to the micro and small enterprises. Right? Payment to the small and micro enterprises is allowed only when it is paid up to the due date of MSME Act Section 15. So this will include that as well. Because it says it is pre-existing on the first day of the previous year, it is in the opening balance, but was not allowable in the last previous year and was paid during the previous year. Okay? And if it is not paid during the previous year also, then it needs to be reported in point B. The B clauses was incurred during the previous year for all the clauses other than 43BH. 43BH is payment to MSME. So in A, you will also include the opening balances of MSME, payment to micro and small enterprise, which was not paid in the last year, or which was not allowed in the last year and is paid in this current year, or is not paid during the previous year. In B, you will include all other payments under 43B covered except for in respect of the MSME. Right? Because in the current year, what you pay to MSME, you have already covered in the above clause. Right? So here you have to report any payment which is incurred during the current year, which is paid on or before the due date of ITR, or which is not paid before the due date of the ITR. Are we clear? Any questions, any doubt? Yes? Okay. So in respect of the GST liability under the reverse charge mechanism, if the liability is booked but not paid on or before the due date of 139(1), then the amount must be reported under this clause, and you can verify the same from the GST 3B or the ledger reconciliation. Okay, so here you have to put all the liabilities of the opening balances as well as those incurred in the current year. So if these are liability incurred during the previous year other than the MSME payments, that should be reported under point B. Because in respect of the MSME payment, if it is in the opening balance, then you can report it in this particular clause. And you will also be reporting it under which other clause? Under clause 22. Remember, we discussed in clause 22 also we were reporting it. Okay? Yes or no? Any questions? So if the same is paid during the current year, it should be reported in clause 26. And you should also check with clause 22 of the previous year as well. Because in the previous year of the tax audit report, you would have reported that these are the payments to MSME which are not paid as per section 50. Okay. And then you should write in this current year that these are paid in this particular year. Okay. Any questions? Any doubt? Yes or no? Is this clear? How we have to report it over here? Anybody else has any question? Okay. Yes or no? Okay. Next clause is amount of central value added tax credits availed of or utilized during the previous year and its treatment in the P&L account and treatment of outstanding central value added tax credits in the account. What is this SENVAT credit? Now there is no SENVAT credit. Now we have the GST credit. Yes, now we have the GST credit. So earlier we used to have the SENVAT credit. Now we have the GST credit. So here you need to mention the opening balances of the GST credit. What is the credit availed, utilized during the year? What is the credit given to you during the year on the purchases? How much you have utilized against the sale or for the payment of the reverse charge? And what is the outstanding amount? And whether you have debited these GST amount, credited to the GST amount to the P&L. So this is yes, nothing but the ITC credit. And how will you verify? From the GSTR 3B reconciliations. Okay. Then the B is particulars of income or expenditure of prior period credited or debited to the P&L account. So any prior period expenses which are there, in case you follow the mercantile system of accounting, you will debit certain prior period expenses or income. So here you can obtain the particulars of the expenditure or income of the earlier year which are debited or credited to the P&L account. Right? So that you need to report it over here. So basically here what will happen is if there is a difference between the expenditure of any earlier year and the expenditure which has been debited in this particular year. So you may look at it and see that why it is like that. Is it because that the liability has materialized or crystallized during this year? Right? So basically any prior period expenses has been booked now or any prior period income has been booked now. Right? So that you need to obtain the information and report it over here. Fine? Any questions, any doubt? If the expenditure is crystallizing during the current year, it is not prior period. But if it is pertaining to a prior period and debited in this year, then you need to report it over here. Then we have clause 29A, which is talking about whether any amount is to be included in income chargeable under the head income from other sources as referred to in clause 9 of subsection 2 of section 56. What is 5629? What is 5629? Amount forfeited, yes, against the advance received. Advance money forfeited. So 5629 provides that any advance received, right, in respect of transfer of capital asset which has been forfeited is going to be considered as income from other sources under 5629. So here you have to report the nature of the income and the amount which is there, right? So here basically you will be required to obtain the representation from the client regarding all the advances received which have been forfeited. That you have to report it over here. Then 29B is whether any amount is to be included as income chargeable under the head income from other sources as referred to in 56 to 10, and you have to furnish the nature of the income and the amount thereof. What is 56 to 10? Amount received without consideration, immovable property received lesser than the stamp duty value, which is for inadequate consideration or without any consideration, movable other than immovable property received for inadequate or without consideration, that you need to report it. Right? So here you have to see how the assets are received or the cash is received. Then you should obtain the contracts, right, or the agreements to scrutinize on what basis these are received. What is the stamp duty value in case of immovable property? What is the fair market value? So here you need to report the nature of the income and the amount which is there. Clear? Then next is clause 30, which is talking about details of any amount borrowed on hundi or any amount due thereon, including the interest on the amount borrowed, repaid otherwise than through an account paid check. Right? So here you have to report the amount borrowed on hundi and the details of the repayment. Right? So here you should verify the borrowings or the repayments and should report it over here. Very simple. 30A is whether primary adjustment to the transfer price as referred to in section 92 CE has been made during the previous year. What is a primary adjustment? Primary adjustment is nothing but if there is a difference between your arm's length price and the transfer price at the price at which you are transferring the goods to the associated enterprises. So if there's a difference between the two, the adjustment is made to your income. So then you need to report it over here. Okay. So here you need to look at the transfer pricing documents. You need to look at the transfer pricing audit report and should put it over here as a point. Okay, so this is basically pertaining to any primary adjustment which is made, right? It may be made by the assessee himself. So you need to look into the transfer pricing report or the computation of income. It may also be made during the year in respect of any earlier previous year also in case the assessment has taken up by the assessing officer. So that you need to see as per the assessment orders that if there is any transfer pricing adjustment which has been made on the assessee. Are we clear? So that needs the reporting over here. Yes, there's a question. After clause 27, there is a clause 29A. Yes, there may be, one second, let me just check. Let's check the 3CD form to see if there is a mistake over here or is it really like that. Thanks for highlighting, Sanjay. No, 28 is omitted and 29 is also omitted. So this year they have been omitted. So directly there is 29A. So maybe that's a mistake by the government itself. Okay. Then we have 30AB. It's asking if yes, there's a primary adjustment, then under which clause of section 92 CE primary adjustment is made. That is why the primary adjustment is made. Is it made by the assessee himself? Is it made by the assessing officer? Is it made as part of the safe harbor rules? So how the primary adjustment has been made over here in this particular case. So that you need to report it over here. Are we clear? Then amount of the primary adjustment which has been made. Whether the excess money available with the AE is to be repatriated to India as per the 92 CE. If yes, whether the excess money has been repatriated within the prescribed time. If no, the amount of the imputed interest income on such excess money which has not been repatriated within the prescribed time. Now see, this is you are going to learn in detail in the transfer pricing class. So what happens is, just let me give you a brief idea. So whenever any transaction is there with the associated enterprise, right, it has to be at the arm's length price. Now if the transaction is not taken place at the arm's length price, then obviously there will be the adjustment made to the total income of the assessee. either by the assessee himself or by the assessing officer, which is nothing but the difference between the arm's length price and the actual price at which the transaction has taken place. Right? So in the clause 30A, you have to just mention whether any primary adjustment is made. That's what the first part of it. And under which clause the primary adjustment is made, this is to be reported in B. That is whether it is made by assessee himself, whether it is made by AO, whether it is made under the safe harbor rules, whether it is made as a part of the mutual agreement procedure, how is it made? Okay. Now, once the primary adjustment has been made, right, then the foreign company, foreign associated enterprise has to send the amount, equivalent amount of the adjustment back to the Indian entity to say that if the transaction has not taken place at the arm's length price, let's say if I have purchased the goods of, let's say, rupees 100. Okay, let's say I have made the sale, the Indian company has made the sale of rupees 100 to the foreign company. Both are associated enterprise. However, the actual arm's length price for those goods is, let's say, 120. The sale has been made at 100. Arm's length price is 120, meaning that 20 rupees is going to be my primary adjustment. Because I have made the sale at lesser than arm's length price. Now the foreign entity has to give this 20 back to the Indian entity to reconcile the books of accounts with the transfer pricing adjustment. If it does not send 20 back to the Indian entity, then secondary adjustment may be carried out in the form of imputed interest or the notional interest on that amount. Okay, so you will learn that in the transfer pricing class, that the interest will be charged on the excess money if the amount is not repatriated within 90 days to the Indian company. So here they are asking about the same thing. If the primary adjustment is made, what is the amount of primary adjustment and whether the excess money is repatriated within the 90 days. If yes, whether the money has been repatriated within the prescribed time. If no, then the amount of interest on the excess money which has not been repatriated. Are we clear? So here, what you need to report is, the reporting has to happen for the previous year. Are we clear? So here the interest which is there has to be computed only till the end of the previous year, even though it may go for a longer time, but the tax auditor has to report only up till the end of the previous year. Or if the interest is given till the date of the tax audit report, then he needs to just provide the breakup. So that here needs to be reported by the tax auditor. So here the tax auditor should look at the transfer pricing report. He should look at any advance pricing agreements entered into by the assessee. He should look at the orders of the assessment if any transfer pricing adjustment has been made into that, any appeal orders which are there, any mutual agreement procedure which has been there. And based on that, he should be reporting over here. Are we clear? He can also rely on the management information by verifying just the amount, and basis that he can report it over here. Any questions, any doubt? Yes, 92C you will complete in the transfer pricing class. Okay. Then 30B is whether the assessee has incurred expenditure during the previous year by way of interest or similar nature exceeding rupees 1 crore as referred to in section 94B. If yes, furnish the amount of interest expenditure incurred. What are the earnings before income tax, depreciation and amortization during the previous year? Amount of expenditure by way of interest as per above, which exceeds 30% of EBITDA. Details of interest expenditure brought forward and details of interest expenditure carried forward. Now here, what do you need to report is, let me tell you. So basically, again, this you will learn 94B section in the transfer pricing class in detail. However, let me just tell you very briefly what is it. So here 94B says that if the assessee has any interest expenditure in respect of loan taken from the associated enterprise or in respect of any non-resident lender where the associated enterprise has given the guarantee in respect of that loan, and the interest amount is more than 1 crore, then the interest deduction shall be restricted to the 30% of the EBITDA. The excess interest, which cannot be claimed as a deduction, shall be carried forward for a period of 8 assessment years. So that is the reason why they are asking you whether there is any interest expenditure which is on the loan taken from the non-resident associate enterprise or from any non-resident lender where the AE has given the guarantee. Then what is the amount of expenditure? What is my EBITDA? What is the interest restricted to 30% of EBITDA? What will be carried forward to the subsequent years? And if there is any interest brought forward from the previous year. So that needs to be reported over here. Now, how will the auditor verify this? The auditor here will again look into whether there is any interest paid to these associated enterprise. He will obtain the list of the associated enterprise. He will see whether there is any interest paid and he will restrict it to up to the 30% of the EBITDA. Any questions, any doubt? Yes? Okay. Fine. Yes or no? Any questions, any doubt? Is AE enterprise in India or outside India? Outside India. It will be outside India. Okay. Fine. Yes. Okay. Next is 30C, which talks about whether the assessee has entered into an impermissible avoidance arrangement as referred to in section 96 during the previous year. If yes, please specify the nature of impermissible avoidance arrangement, amount of tax benefit in the previous year arising in aggregate to all the parties to the arrangement. So that needs to be reported over here. Now what is this? You would have done something called as general anti-avoidance rules. Yes or no? Have you done it or not? Not done yet, so you will do it. What is GAR is? GAR is the general anti-avoidance rule, which says that or which targets any tax avoidance transaction. So if there is any impermissible avoidance arrangement, what is an impermissible avoidance arrangement? The arrangement where the main purpose is to obtain the tax benefit. Right, where the main purpose is to obtain the tax benefit. And where the arrangement lacks the commercial substance or is misusing the provisions of the act or is creating any rights or obligations which are not at arm's length or is not for bona fide purposes. So that is the impermissible avoidance arrangement. So here, what they are trying to ask the tax auditor is to identify that whether there is any impermissible avoidance arrangement taking place. Right? Now, what is the nature of the tax audit? What is the auditor required to do in the tax audit? He is required to certify that the particulars of Form 3CD are true and correct. Now, he is not required to undertake the investigation because audit is not investigation. He may not have sufficient access to the books of accounts and other records of the other parties to the arrangement, because the arrangement can be with multiple parties. It is not that, it is only with the assessee himself obviously will not have any arrangement with himself. He will obviously, give loans to the other parties, which may not be, bona fide. So how will the auditor verify? He will not be able to come to a conclusion to identify whether this arrangement is true and correct. So, basis that, he should make an appropriate disclaimer in respect of reporting under this clause in the Form 3CA or 3CB, that in the absence of the access to the books of accounts and the records of the other parties to the arrangement, and because the audit is not the investigation is not the scope of audit, the auditor is not able to determine whether the arrangement is an impermissible avoidance arrangement and not able to determine the tax benefit arising in this case to all the parties to the arrangement. Are we getting this particular point? If it comes to the notice of tax auditor that, some proceedings have been initiated under the GAR by the commissioner in any earlier previous year and they have declared an arrangement already as an impermissible avoidance arrangement, and in this year therefore he can, further examine the transaction, that is a different story, right? Or where any reference have been made in earlier year for declaring an arrangement as impermissible avoidance arrangement by the assessing officer, then we can further examine. But if we do not know it already, how will he examine? So here, even though the government is asking in 3CD, but the auditor will not be able to comment on this appropriately. Are we clear? Any questions or doubt? Okay. Yes or no? Okay. Next is clause 31, which is asking you about particulars of loan or deposit in an amount exceeding the limit specified in 269 SS taken or accepted during the previous year. What is 269 SS? Cash in excess of 20,000. Yes. So here what it says is 269 SS says that you need to give the prescribes the mode of taking or accepting the loans or deposits or the sum in respect of transfer of immobile property. So there are three things covered under 269 SS: loans, deposits, sum for the transfer of immobile property. So no person should accept from any other person these amounts by other than the account paid check, bank draft or the ECS. Right? More than rupees 20,000. That is 269 SS. Now here this clause seeks particulars of each and every loan, each and every deposit or each and every amount for the transfer of immobile property more than 20,000 which is taken or accepted. Are we getting this? So here you have to give the particulars of each and every amount. whether even if you have given loan, if you have accepted loan as well as amount in respect of transfer of immovable property from same person, then both needs to be reported separately. And reporting is only required when the amount is more than 20,000. Either together or in individual cases. Okay, so the tax auditor should obtain the details from the assessee in respect of each loan or deposit and verify if the same has been reported over here. So here you need to give the name, address and PAN or Aadhaar number of the lender or the depositor, amount of each loan or deposit taken or accepted, and code of the nature of such amount, and whether the loan was squared up during the year, whether what is the maximum amount outstanding at any time during the previous year, whether the loan or deposit was accepted by the check or bank draft or ECS. In case of loan or deposit was taken or accepted by check or bank draft, whether the same was accepted by an account pay check or account pay bank draft. So all this information you need to report it over here. Okay, is this clear? And where the tax auditor may not be able to verify what was the mechanism to accept this, because he will not have the access to whether the check was account paid. They will not here maintain the check. They will not maintain the bank draft. So then they can just put a comment that it is not possible for us to verify whether they have been accepted otherwise than by account paid check, as the necessary evidence is not in the possession of the assessee. Are we clear? So obviously the client would not maintain these information that how the checks are. So there will be practical difficulty in verifying the loan or deposit, whether it is taken by account pay check, whether it is by other than account pay check. Then in that particular case, they will just put this particular report over here or the comment over here. Fine. Then 31B is particulars of the specified sum in an amount exceeding the limits of 269 SS. What is a specified sum? As I said, the specified sum is in relation to the transfer of immovable property. That you need to mention over here. The name and address of the PAN number, amount of loan or deposit taken or accepted, whether the specified sum was taken or accepted by the check or bank draft, and was it the account pay check. Again, the same reporting needs to be done in respect of the immovable property. Okay, so here the auditor has to ascertain whether the assessee has any immovable property which has been sold, transferred during the year, or which is proposed to be transferred, and he has taken some advance. Even advances will be reported over here. And how the proceeds from such transfer have been received, whether they are by the account pay check, account pay draft, ECS, bank draft, how is it exactly? Okay, then BA is with respect to particulars of each receipt in an amount exceeding the limit specified in 269 ST in aggregate from a person in a day, or in respect of a single transaction, or in respect of transactions relating to one event or occasion from a person during the previous year, where such receipt is otherwise than by a check or bank draft or use of ECS. Then you need to mention over here name, address, PAN, and the nature of the transaction, amount of receipt, and the date of receipt. Now, what is 269 ST? What is 269 ST? Receipt of cash greater than 2 lakh. So here you need to give the particulars of the receipts more than 2 lakh either individually or in aggregate from one person in a day or relating to one event. Right? So even if the receipts or payments are on different dates and individual receipts are less than 2 lakh but they are from same person or in respect of same transaction, then that needs to be reported. So where the assessee has received the amount, in that particular case, you need to report it under BA. Okay. And BB, that is, it is asking you the particulars of each receipt in an amount exceeding the limit in 269 ST in aggregate from a person in a day, or in respect of single transaction, or in respect of certain transactions relating to one event or occasion from a person received by a check or bank draft, not being an account pay check or an account pay bank draft. And you have to here report the name, address, PAN, the amount of the receipt. So what is the difference between the two? In the BA and BB, both you need to mention the amount more than 2 lakhs, sorry. Are we getting it? In both the cases, you need to report more than 2 lakh, but here it is otherwise than by the check, meaning here it will only cover in BA the cash receipts. In BB, you need to report the amounts received other than through the account pay check. Are we getting this particular difference? So that needs to be reported over here. Whereas in BC, what it is saying, particulars of each payment made in an amount exceeding the limit specified in 269 ST. So BA, BB is for the receipt. BC is for the payment made to a person, which is otherwise done by a check. And BD is otherwise done by an account pay check. Again, it is a payment. Are we getting it? So both the payments as well as the receipts need to be mentioned in this entire clause. So here you need to see when the receipts are, whether it is from a single person in a day. And for this, the tax auditor has to look at the receipt and payment both. They have to link all the receipts and payments in a particular ledger to see that it is to a same person or not, or whether it is for the same event or not. Single invoice may relate to multiple transactions, or multiple bills may relate to a single transaction. So they will have to rely on this representation that why is it for. Okay. For example, for a function organized by a person, the assessee may have given a catering contract as well as contract for flower decoration. Now the transactions are different. The event is the same. And 269 ST will be attracted if the receipts are by mode other than those specified in the section. Now it is also possible the assessee may have purchased the goods and have sold the goods to the same party, and for which the consideration exceeds 2 lakhs. And the purchase and sale is set off against each other. Then in that case also the tax auditor has to give the appropriate note to the effect that the set off is not a receipt or payment, and therefore it has not been considered under this section. So this is how the reporting needs to be made over here. Are we clear? Yes or no? Any questions, any doubt? Yes? What should I repeat, Sanjay? Which point you want me to repeat? So 269 ST says that no person shall receive a sum of rupees 2 lakh or more in aggregate from a person in a day, or in respect of a single transaction, or in respect of transactions relating to one event or occasion from other person. Otherwise then by account pay check. Yes. So here 269 ST reporting which has to be there is to be done in clause BA, BB for receipts, BC, BD for the payments. Now what does 31 BA says and BB says? BA seeks the detail of the receipts which are in cash. BB seeks the details of the receipts which are other than the account pay check or the ECS, meaning by cross check. Right? BC and BD seeks the detail of the payment. BC seeks the details of the payment in cash. BD seeks the details of the payment by otherwise than the account pay check, meaning by the cross check or something like that. Is this clear, Sanjay? Yes. Clear? Yes, 269 ST talks about only the receipt, but here they are asking you the details so that if the other party does not disclose it and if you have made the payment, so the government can get the information from you also. Okay? That is the reason why they are asking. Fine? Okay. Next one is the point D. Sorry. C. Particulars of each repayment of loan or deposit or any specified advance in an amount exceeding the limit specified in 269T made during the previous year. 269T is attracted where there is a repayment of loan or the deposit or the amount for the immobile property more than rupees 20,000 otherwise than by account pay check, bank draft or the ECS. Right? So here you need to report again name, PAN, Aadhaar, amount of each repayment of loan or deposit or the specified advance. If the advance for the immobile property is returned back, maximum amount outstanding at any time during the previous year, whether the repayment was made by the check or bank draft or ECS. In case the repayment was made by the check or bank draft, whether the same was by an account pay check or bank draft. So that needs to be reported under 269T in this particular clause. So again, you will need to see how the repayment has been made for each and every loan or for the advances in respect of the immobile property. And D asks you the details about particulars of the repayment of loan or deposit or any specified advance in an amount exceeding the limit in section 269T received otherwise than by an account pay check or ECS. So C asks you the detail whether there is any loan which has been made otherwise than by the which is there more than 20,000 and what is the mode of that. And here it is asking about what is the exact amount of that. So again here you have to put the name, address, PAN, amount of the repayment or advance which is otherwise done by an account pay check, that you need to mention it under this particular point. So here the details of the repayment received by the assessee from a person in respect of the loan or deposit or specified advances exceeding the limit otherwise than by account pay check has to be reported in the D point. Okay. And then finally, we have the E point which talks about the particulars of repayment of loan or deposit or any specified advance exceeding the limit specified in 269T received by a check or bank draft which is not an account pay check or bank draft. So under this subclause, what you need to report is the auditor has to verify whether the repayment is other than the account pay check. So here, what is the difference is? C point is you have to give the repayment of loan exceeding the 269T. Here just you have to mention the details whether it is by account pay check or not. You have to mention the detail of all the repayments which are there which are exceeding the 269T limit. Are we getting this? Yes or no? This you have to mention in this particular clause. In the D clause, you have to mention particulars of the repayment of loan or deposit which are received by the assessee. Not made. Here you are received by the assessee. So that you need to mention which is Otherwise, then by a check or bank draft, not the account pay. Just the check, which is the cash payments basically. In E, you have to mention any payments made through the cross check like that. So are we getting? C is the repayment made, D is the repayment received in cash, E is the repayment received through the cross check. Are we getting this particular clause? Any question, any doubt? Okay, fine. Okay, so let us take a break here for 10-15 minutes and then we get back. This is clause 32. Details of brought forward loss or depreciation allowance to the extent available containing information relating to the assessment year, nature of loss or allowance, amount as returned, or losses or allowances not allowed under 115 BAA, BAC, BAD. So, what are these losses, students? Yes. Concessional taxation is fine, but what are these losses? Yes. So, brought forward losses, depreciation, which are there, right? Here, you have to report that. But what is about the 115 BA, BAC, BAD about those sections? Yes. Which losses are not allowed under that section? Yes. Loss from house property, yes. Then any losses which are pertaining to the deductions not allowed, right? So here what you need to report is basically the nature of the loss or allowance and what is that you have claimed in your return or in the assessment. What are the losses not allowed under 115 B AA, BAC, BAD, BAE, those section, right? And additional depreciation, which is withdrawn, right, on account of the taxation under these concessional tax regime. So basically, you need to report it like that. Okay. So that is something which is a very easier thing. Only these things needs the reporting over here, right? The losses which are there. So what are not allowed, that only you need to put it over here. So you need to look at past returns, revised return or updated return and see what is the carry forward of the loss which has been there. Or in case of the assessment which is there, assessment orders, to see whether any losses have changed because of the assessment. So the tax auditor needs to see that. Okay. And basis that you have to report over this particular point. Okay. Fine. Then the B point is whether a change in the shareholding of the company has taken place during the previous year due to which the losses incurred prior to the previous year cannot be allowed to be carried forward in terms of section 79. What is this? What is section 79? Yes. What is section 79? Yes, students. Yes. Faster, students. What is section 79? 79 is with respect to the restriction in the set off and carry forward of losses due to change in the shareholding. Yes or no? So if there's a change in the shareholding, then the losses of the previous year cannot be carried forward, right? If more than 51% shareholding changes. In case of startup, if all the shareholders changes, right? So here the tax auditor should obtain the detail of the changes. He should look into the shareholders list, whether there has been any change in the shareholding. And based on that, he should determine whether the breach has happened in respect of section 79 and what are the losses which now needs to be, which gets lapsed because of the change in the shareholding. So year on year, this exercise has to be carried out. Fine. C is whether the assessee has incurred any speculation loss referred to in 73. If yes, please furnish the details of the same. How will the tax auditor verify the speculation loss? Yes. Yes, how will he verify? Yes, students. By checking the books of accounts, yes, but how will he check whether there's a speculation income? So he will have to see whether there is any activity which is carried out, like, the purchase and sale of the commodities or the shares without taking the delivery of the same, right? So based on that, the auditor needs to verify whether there is any speculation business which has been carried out, right? So that losses, if are pertaining to that business, that needs to be reported over here. And if there are two business, the auditor should see whether there are, separate expenditure maintained with respect to the speculative business or not, whether there is any unabsorbed depreciation relating to that or not. So basis that, the auditor has to report it over here. Are we getting this? So that is something which needs to be, then he has to report any speculation loss over here. Fine. Next is whether the assessee has incurred any loss referred to in section 73A in respect of any specified business during the previous year. If yes, please furnish the detail of the same. So again, the tax auditor will have to verify whether the assessee is carrying on any specified business. And if yes, in case there is any loss pertaining to that, whether there is segregation of expenses between the normal business and the specified business, right? So again, basis that, the auditor has to report here. Okay. Next is in case of a company, please state that whether the company is deemed to be carrying on a speculation business as referred to in explanation to section 73. If yes, Please provide the detail of the speculation loss, if any, incurred during the previous year. What does this mean? Which company is deemed to be carrying out the speculation business? Yes. Yes, students, faster. Which company is deemed to carry out the speculation business? So the explanation to 73 provides that where business of the company consists of purchase and sale of the shares of the other company, it shall be deemed to be carrying out the speculation business. The exception to that was any company whose GTL mainly consists of income from interest on securities, IFHP, capital gain, income from other sources, or a company the principal business of which is trading in shares, or a banking company, or a company granting loans and advances. These were the exception. So if there's a company whose principal business is of the purchase and sale of shares of other companies, then it shall be deemed to be carrying out the speculation business. So here the tax auditor has to furnish the detail regarding the speculation losses claimed by such type of company. Okay? Any questions, any doubt with respect to this? Fine. Next is clause 33, which is talking about the section-wise details of deductions, if any, admissible under Chapter 6A or Chapter 3, which is 10AA, specifying the section under which the deduction is claimed and the amounts admissible as per the provision of Income Tax Act, and fulfills the conditions specified under the relevant provisions of the Income Tax Act or rules or any other circular or guidelines. So here, what does the tax auditor need to check is, with respect to this, you need to check that whether there are any deductions claimed under Chapter 6A. So the tax auditor will need to see that what is the business or the profession of the assessee, right? And what are the deductions which are claimed in the return of income? Whether 10AA deduction have been claimed in the books of accounts and also in the return of income. If the tax auditor is issuing this particular report, right, in form 3CB or 3CA, so he will have to take into consideration the tax audit report of even the branches also, right, which may be audited by the other tax auditors, because there may be separate tax audit of each branch, and by the HO also. So you will have to see whether any deductions are claimed under Chapter 6A in respect of any branch for ICAI, IB, 10AA, all of that. Right? It may also be a possible case that if the tax auditor is auditing the individual or HUF, and they may have certain personal income also, and therefore personal deduction under 80C, 80D also. But the tax auditor is required to audit for the business of the sole proprietor. So here, which deductions have to be given? Whether all 80C, 80D deductions also in case of individual, or only for the sole proprietor? So here, only with respect to the business deductions which are claimed, under respect of which the audit is carried out. The deduction under the income tax return for an individual may relate to its salary income also. Here I have to just report the deductions which are pertaining to the business, because the audit is for the business. So here the tax auditor has to ascertain that the conditions of each and every deduction have been satisfied. He should obtain all the necessary evidence which would enable him to express the opinion regarding the admissibility of deduction. He should see whether the assessee has really deposited the amount in so and so specified expenditure for which the deduction is allowed, whether it is as per the limits or not, whether it is within the time limit the amounts have been deposited. So all the conditions have been met for the deduction or not. Right? So basis that, the tax auditor has to give the deductions over here. And he has to also see whether if the deductions are claimed under ATIA, ATIB, ATIC, ATJJA, whether a separate audit report is required to be issued. Because under under that particular section, the assessee has to obtain the audit report with reference to that sections also, in respect of undertaking for which these deductions are claimed. So the tax auditor should also refer to the audit reports for those particular section. Because if you are claiming ATIA, ATIB deduction, you need to also obtain the audit report with respect to the deduction claim for that specific undertaking. So the tax auditor needs to refer to those audit reports. He should refer to the figures given in those audit reports, referring to the work of the another auditor, using the work of another auditor, SC 600. Right? So basis the certificate issued by the chartered accountant for 10AA for these audit reports under ATIA, ATIB, you need to take into consideration that for respect of this particular reporting over here under clause 33. Are we clear? Yes or no? And in case the assessee is opting for concessional tax regime, they should not claim any particular deductions under these sections. Okay? So any chapter 6A pertaining to ATG, ATGGB, ATJJA, whether the expenses have been really paid, right? So basically all that point need to be checked. Are we clear, yes or no? Okay. 34 is whether the assessee is required to deduct or collect the tax as per the provisions of the TDS and TCS. If yes, please furnish the details of the TAN, section number, nature of payment, total amount of payment or receipt which is there, total amount on which tax was required to be deducted or collected, total amount on which tax was deducted or collected at the specified rate, amount of tax deducted or collected, and the total amount on which tax was deducted or collected as less than the specified rate, or the amount of tax deducted or collected at the less than specified rate, and the amount of tax deducted or collected not deposited to the credit of the central government. So basically here what needs to be reported is all the particulars with respect to the TDS. Right? So here you need to report the TAN, the section number, what is the nature of payment, what is the TDS rate, whether the TDS has been deducted or not, what is the actual payment made, whether the TDS has been deposited to the government or not, right? So here all these information needs to be reported. Now there is a possibility that the tax auditor may feel that this payment is liable to TDS, or it is liable to TDS, let's say in the 194C, but the assessee has deducted under 194J, or the assessee has not deducted the TDS at all. Then that needs to be reported as a part of the observation in form 3CA or 3CB. So the preparation of this information is of the responsibilities of the assessee. The tax auditor has to just verify the compliance as required in this clause. The tax auditor is required to verify that no items have been omitted in the information which is furnished under clause 34. And the information is correct. So how will he verify this? How will the tax auditor verify this? How will he check this? How will the tax auditor verify this? From the income tax portal using TAN number? No. So basically he has to see all the payments made to various parties. He has to not only see the expenses debited to P&L, he should also see the payments made to various parties, because if an advance payment is made, that is also liable to TDS, right? Because the TDS is on credit or payment, whichever is earlier. So you don't only need to check the expenses in P&L, you should also check all the payments which are made, whether they are subject to TDS. Then you have to check with the TDS returns. What is the TDS rate which is applied, under which section the TDS has been deducted? If case the payment is made to non-resident, whether the TDS is as per the DTAA or as per the Act. Because here you need to mention the total amount of the amount which has been paid. And if there is a lesser deduction, then the specified rate, that also needs to be reported. So in case the deduction is, let's say, under 194C, 194J, but you have deducted in the 194C. Let's say instead of 10%, you have deducted at 2%. So that needs to be also reported in this clause. Or if there is no PAN, then whether the TDS has been deducted at higher rate or not. So basically the tax auditor needs to obtain the TDS TCS return and should consider all the circulars, notification, judicial decision, and accordingly should verify this particular clause. Are we getting this particular point? So the tax auditor needs to give us affirmation with regard to the applicability of, first of all, the provision of TDS and TCS. He should obtain the TDS TCS return. Of course, if it's, too many transactions, if it's a very big company, there may be many transactions, you should apply the concept of materiality and can, do the test check. He can do the sampling there. Right? So, it may not be possible for the tax auditor to decide which expenditure sometimes, results in a benefit or perquisite. Then he can seek the management representation in that case. But the tax auditor has to check and verify the payments made by the assessee, the total payments, and not just restrict to the expenditure which is debited to the P&L account. He should look into whether the TDS rates which are deducted are lower, maybe because lower deduction certificates are received. So he should maintain the working paper for the same. Right? So basically on those basis, he should take into consideration all these points. Whether if there are non-filers, then you have to deduct at a higher rate. So you should check in the utility for that. So basically all these points need to be taken into consideration. Clause B is whether the assessee is required to furnish the statement of tax deducted or tax collected. If yes, please furnish the details of TAN, type of form, due date for furnishing, date of furnishing, if furnished, whether the statement of TDS or TCS contains the information about all the transactions which are required to be reported. If not, please furnish the list of details or transactions which are not reported. Now here the 34A was with respect to the payments made. 34B is with respect to the TDS TCS returns. Right? So you have to also ensure that you reconcile 34A and 34B with section 40A 1 and 1A, right, in the return of income. In 34B, you are required to state that whether the TDS TCS returns have been filed, all the transactions which are required to be reported, on which the TDS have been deducted, are reported in the TDS return or not. And in what time limit the TDS returns have been furnished, whether they are furnished after the time or whether they are furnished in time. Okay? Okay? Yes, any question, any doubt? Then the C is whether the assessee is liable to pay interest under 201 money or 2067. If yes, please furnish the TAN amount of interest. Basically, C concerns any interest on the late payment, short payment, right, for the TDS. not deducted, or deducted but not paid, and similarly for TCS. So the auditor should verify the amount from the books of accounts as on 31st March and also from the TDS TCS statement generated. Right? In case the assessee has disputed the levy or calculation of interest under traces of Form 26AS, the auditor may recalculate the amount of interest under 2011A and report accordingly. If interest is not paid till 31st March and provision is also not made, then the auditor should report that as well. Okay? Is this clear? Yes? Okay. Clause 35 is in the case of a trading concern, give the quantitative details of the principal items of goods traded, opening stock, purchases, sales, closing stock, shortage or excess. So here you will only report for the trading concern. And here the auditor should obtain the certificate from the assessee in respect of only principal goods. And should enter the quantitative information basis that. In B, you will report for the manufacturing concern, wherein you will give the detail of the raw material, what is the opening stock, purchases, consumption, sale, closing stock, yield of finished product, percentage of yield. Okay. And here, with respect to this stock, may be difficult for the tax auditor to verify each and every item of purchase, consumption, sales and production. Therefore, he can use the sampling method and satisfy himself with respect to the correctness. And basis that, he will have to report it. So only, the item. Okay. Next is 36A. Whether the assessee has received any amount in the nature of dividend as referred to in 222E. What is 222E? If yes, furnish the details, amount received and date of receipt. What is it? Yes. Is the loans or advance to a shareholder which has more than 10, which holds more than 10% of the voting power. In that particular case, it is considered as the deemed dividend, isn't it? So in this particular case, the tax auditor will have to look into the books of accounts, will look into the 26AS, whether any TDS has been deducted, right? He should obtain an undertaking from the client with respect to that, whether the assessee himself is not holding the shares, but let's say a partnership firm is there, it is not holding the shares itself in the company, but through its partner, deemed dividend will be considered in the hands of the partnership firm or in the hands of the partner. So the registered shareholder is the partner, but the beneficial owner is, let's say, the partnership firm. So you need to see, the tax auditor needs to see that, whether compliance has been done under the Companies Act. And with respect to ascertaining this, whether the assessee has any dividend, deemed dividend or not, he needs to obtain from the assessee a certificate with respect to the list of the closely held companies in which he is a beneficial owner of shares, where he has not less than 10% of the voting power, or the concerns in which he has a substantial interest, more than 20%, voting power or profit sharing. He should also obtain a certificate from the client giving particulars of any loans or advances received from any concerns in which he has a substantial interest from any closely held company. Right? So these certificates are necessary since the tax auditor may not be directly able to verify from the books of account. And this he should mention in Form 3CA or 3CB. Right? So any payment made by a closely held company, if it is made on behalf of or for the benefit of the shareholder, then again there may not be any record available. Right? So in that particular case, that does not need to be reported if there is no record available. Are we clear? So wherever the beneficial shareholder is not the registered shareholder and comes to a beneficial, now again the tax auditor may not be able to verify the accumulated profits as on the date of payment of loan or advance. Right? So the tax auditor may not be able to determine that. So in that case, he may arrive at the accumulated profits by appropriating the profit for the year on a time basis. And he should make again the appropriate remarks in the tax audit report. Okay, any questions, any doubt? Fine. Next is 36A, whether the assessee has received any amount in the nature of dividend referred to in 222. Okay, this is done, sorry. Whether the assessee has received any amount for buyback of shares as referred to in 222F. If yes, please furnish the following details: the amount received, the cost of acquisition on the buyback of shares. So here, now 222F considers buyback as the dividend, amount received on buyback as dividend. So here, the tax auditor has to verify that this is only the amount reported after 1st October 2024. Because before that, it was not considered as dividend. So in case of the individual or HUF, there could be a case where there are, two set of financials. One consisting of business accounts and the other for the personal accounts, because he may be a sole proprietor. The tax auditor should take into consideration whether the amount received as buyback is forming part of the business accounts. Because if the shares and security form part of the personal accounts, then no reporting is required to be made in this clause, because the tax audit is for the business. However, if the shares and securities have been purchased using the business income, then only here and if it forms part of the business account, then only here the amount needs to be reported. And the amount can be verified from the AIS or TIS. Because every company now will report it there and will deduct the TDS also. The actual cost of purchase can be taken from the contracts. Clear? Next is clause 37. Whether any cost audit was carried out. If yes, give the details, if any, of disqualification, disagreement on any matter, item, value, quantity as may be reported or identified by the cost auditor. Now, how will the tax auditor know whether the cost audit has been carried out? He should ask from the management whether there is a requirement to carry out. And if yes, give the copy of the same. The tax auditor is not required to make any detailed study of such a report. He has to just identify any disqualification or disagreement which is there and mention it over here. Are we clear? Any questions, any doubt? Yes or no? Is this clear? Both the clauses, buyback and this cost audit. Anybody, any questions, any doubt? Okay. Next is 38. Whether any audit was conducted under the Central Excise Act. If yes, again give the details of the same. Now, this is with respect to Central Excise Act. Again, same thing. The auditor needs to ask the management if there is any report which is issued. He just needs to report it over here in the 38 clause that yes, there has been a separate report which is asked for it. Next is, one second. Yes. And then next is with respect to clause 40. Why there's clause 39 not there? I think 39 again has been omitted. Yeah, 39 is there. If whether any audit was conducted under 72A of the Finance Act in relation to valuation of taxable services. Again, this is service tax audit. So if there is something like that, you need to report it. Let's come to clause 40. Details regarding the turnover, gross profit for the previous year and the preceding previous year. So for 2 years, you need to mention the turnover, gross profit to turnover ratio, net profit to turnover ratio, stock in trade to turnover ratio, and the material consumed or to the finished goods produced ratio. Right? And again, the details required to be furnished are for principal items of goods traded or manufactured. Now, these ratios have to be calculated only for the assessee who are engaged in manufacturing or trading activity. Right? And as per the financial accounts only. So here, the stock in trade will include only the stock of the finished goods and not of any WIP or raw material. So here, the computation of the ratios have to be worked out, and any significant deviation from the previous year to this year should be reported in Form 3CA or 3CB. And the ratios have to be given the business wise and not the product wise. Are we clear? So the gross profit gross margin ratio will be basically the gross profit divided by the total turnover. Right? Sales turnover ratio will be there. Net profit which is there, that will be taken up. Right? So basis that, you have to just put the ratios over here and for both the years. Next is, please furnish details of demand raised or refund issued during the previous year under any tax laws other than the Income Tax Act and the Wealth Tax Act, along with the details of the relevant proceedings. Now here, the any demand which is raised or any refund which is given under any tax law other than the income tax needs to be mentioned over here. So this may pertain to any previous period other than the current year, but it is issued in this year, so that needs to be reported. So it can be, obtained from the online website, any orders if are there, or management representation should be obtained. You can also check in the CARO, because there also the auditor has to report in the CARO the details of any contingent liabilities. So in case anything of that sort is there, in case of corporate assessee, you can find out from that as well, right? So basically here just the reporting is required. Next is whether the assessee is required to furnish the statement in Form 61, 61A or 61B. If yes, please furnish the Income Tax Department reporting entity identification number, type of form, due date of furnishing, date of furnishing if furnished, whether the form contains the information about all the details or transactions which are required to be reported. If not, please furnish the list of details or transactions which are not reported. Now, what are these forms 61, 61A and 61B? So, in case of 61, right, what is this form 61? So, basically, every person who is required to get his accounts audited, tax audit done, has to furnish a declaration or a statement in Form 61 in respect of the person who has not submitted the PAN but have given the declaration for obtaining the PAN. So, if you know about it, quoting the PAN is mandatory. Right? You need to submit your PAN with any person whom you have transaction. Now, it is quite possible that the other person does not have PAN. So it is a declaration form. Form 60 is a declaration form. But individuals who do not have a PAN, but if they engage in any of the high value transactions, like opening up of a bank account, applying for credit card, purchase or sale of motor vehicle, fixed deposits, buying, selling immobile property more than 10 lakhs, right? So if they do not have PAN and whose PAN are pending, in that particular case, they can give the form 60, which is a declaration that they will obtain the PAN. Okay. So basically, this declaration, if it is collected by me, in case I have high value transaction, any person and they have not reported me any PAN, and I get these declaration, I have to submit these declaration in Form 61, notifying the government. Then there is Form 61A, which is Statement of Financial Transaction or Annual Information Return. If I see any high value transactions, I have to report these transactions to the government. Like, if there is fixed deposits open, sale or purchase of goods more than 2 lakh rupees in cash. So I have to report this, right? So that is Form 61A. Then Form 61B is with respect to the filing of the information with respect to the reportable accounts, foreign accounts. Bank has to report it. If any US citizen has an account, if any foreign citizen has an account, like that. So whether these forms are submitted on time and whether the relevant information has been reported on this. So the tax auditor should take these forms and see whether the information has been reported into this or not. Okay. Then 43 is whether the assessee or its parent entity or alternate reporting entity is liable to furnish the report as referred to in 286.2. Now again you will see this in transfer pricing class. This is called a country by country report. What is this report? So basically the parent company has to furnish a country by country report in its home country with respect to the activities that it carries out all over the world, the employees it has all over the world, what are the incomes that it generates all over the world. So that information needs to be reported. It is called as country by country report. So the tax auditor should verify if the assessee has filed this report. And it should obtain the necessary details about it and report it. If yes, please furnish whether the report has been furnished by the assessee or its parent entity, name of the parent entity, date of furnishing the report. So basically all these things need to be furnished over here. Then with respect to the breakup of the expenditure, 44 is breakup of the total expenditure of entities registered or not registered under the GST. Specifying the total amount of expenditure incurred during the year, expenditure in respect of entities registered under GST, relating to the goods or services exempt from GST, relating to entities falling under the composition scheme, relating to other entities, and total payment to registered entities. Expenditure to entities not registered under GST also needs to be specified. So basically, you will have to bifurcate the expenditure into different parts, that what is with registered entity in respect of exempt from GST, composition scheme, unregistered dealers. So all that needs to be maintained over here. right? So if, let's say, for example, if the registration of the supplier has cancelled, you need to see it on the balance sheet date. Events occurring after the balance sheet date that alter the data does not alter the nature of expenditure, because at that point in time it was from registered supplier. So that needs to be, breakup needs to be given. And here the wording is expenditure. So capital expenditure will also be included. Are we clear? Any questions, any doubt? Yes or no? 61 is to be filed by the basically, year end. Sanjay, 62, what is 62? Okay, 61B. What is six? I didn't get your question. So you are asking what is the due date of 61 and 61B. Is that the case, right? Yes, is this the question? 61A. Okay, got it. For all the three you are asking, what is the due date? Okay. So, in respect of, as I said, that 61B, which is there. Now, this has to be submitted by the 31st of May. Even 61A has to be submitted by 31st of May. So 61A is for the SFT, 61B is for the foreign accounts which are there, and 61 which is there is for the declaration in Form 60. Right? 61 has to be filed. April, year end. Okay, fine. Okay. Any other questions? Any doubt? Okay. So this completes the question that you have till now.
Recording in progress.
The issue involved in this case study relates to the responsibility of the CA in relation to reporting in clause 34A and 21B of Form 3CD for non-deduction of tax and source and consequent disallowance under 40A1. Let us look at it. Where's the case study? One second. Yeah. So facts of the case are a survey was conducted on the premises of a hospital, consequent to which it was found that the hospital had made payments of consultancy charges to doctors without the TDS under 194J, even though the payments to each doctor exceeded a threshold of 30,000. 50,000 with effect from 1/4/2025. In the tax audit report, the amount inadmissible was mentioned as nil in clause 21B of Form 3CD. Also, there was no mention of or reporting of TDS under section 194J in clause 34A. So what should you do? The contention of the CA is the CA contended that since the doctors did not provide any professional service to the hospital, the provisions of 194J would not be attracted. He explained his contention that sometimes due to unavoidable reasons or circumstances, the hospital collected the consultation fee on behalf of the doctors and the same is then paid or remitted to the doctors. Such payments were not expenses of the hospital and hence the question of TDS does not arise. He also contended that as per the decision passed by the special bench of the Vishakhapatnam Tribunal in case of Maryland Shipping and Transport, Section 40A1A is applicable only in respect of the amount of expenditure which are payable as on 31st March of every year and cannot be invoked to disallow the amounts which have been actually paid during the previous year without the TDS. In this case, all payments were made to the respective doctors before 31st March. Therefore, according to him, the payments made to doctors by way of reimbursement of the fees collected from patients does not fall under the ambit of TDS. Even if it does, the same would not be disallowed under 40A1A due to the above decision. Now, there is also a decision of the Supreme Court in case of Palam Gas Service. You have learned that TDS, right? That observe that the TDS is required on the payment as well because the word payable occurring in 40A1A refers only to those cases where the amount is yet to be paid and does not cover the cases where the amount is actually paid. Right? So this cannot be the reading because once the section mandates that the TDS has to be deducted, it has to be deducted not only on the amounts payable but also when the sums are paid during the year. And also the CBDT circular of 2013 which says that the payable would include the amounts paid during the year. Now the question in this case relates to the period prior to the issuance of the circular and the pronouncement of the Supreme Court ruling. So basically, this is the fact which is given to you. Now, 194J requires you to deduct the TDS on the fees for professional services at the time of credit or payment, whichever is earlier. Professional services means services rendered by a person in case of carrying on the listed profession, which includes the medical profession. 40A1A says if the TDS is not deducted on the sum payable, 30% will be disallowed. And you have to report in form Clause 21B of Form 3CD, amount inadmissible under 40A1A, details of payment on which tax is not deducted, date of payment, amount of payment, nature of payment, and the name and address. Right? And in 34A, you are required to report the TAN, nature of payment, section number, total amount of payment, total amount on which tax was required to be deducted, actual tax deducted, right? And total amount on which tax was deducted at lesser than that rate, right? And the amount of tax deposited to the central government. So now what do you think should be done in this case? Yes. See, in this case, if you look at it, the facts of the case, it says that the hospital had made the payments of consultancy charges to the doctors. Right? And these are without any TDS. Now, even if the CA has relied on some ruling, he needs to report it under the Form 3CA regarding this. So, and CA has completely ignored clause 24, clause 21 as well as 34. And has not exercised the due diligence in carrying out his professional duties. Hence, he is guilty of professional misconduct as per the part 1 of second schedule. What does part 1 of second schedule says? The clause 7 says that a CA in practice shall be deemed to be guilty of professional misconduct if he does not exercise the due diligence or is grossly negligent in the conduct of his professional duties. So the tax auditor has to be very, very careful while reporting under the 3CD. In case he takes some view that the tax is not deductible by virtue of some relying on judgment, he should disclose the same in his report. Are we clear? Yes or no? Okay. Next is search was conducted under 132 of the Income Tax Act in the case of PQR Jewelers, a leading gold jewelry retail chain on 31st Jan 2026. As part of the post-search inquiries, data from the billing software was analyzed. On analysis of this data, it was found that the concern was involved in violation of 40A3 in a major way to the tune of 30 crores in the purchase of old gold. What is 40A3? What is 40A3? Payment in cash more than 10,000. That's right. So, the tax audit report of the concern was issued by a CA. The audit report has a specific clause of 21D with respect to 48. However, the CA had not properly filled up this clause and had failed to highlight the extensive violation of 48. Right? So, what is 21D asking about? On the basis of the examination of books and other relevant documents, whether the expenditure covered under 48 read with Rule 60D were made by account pay check or bank or account pay bank draft. If not, please furnish the detail. Now, in this case, what is the contention of the CA? The CA contends that he had done some test check and he did not come across any payment which warrants the disclosure in Form 3CD. He did a sampling exercise. Obviously, if the data is so voluminous, he can't be checking one by one item. He also submitted that the standing instructions were given by the management to the employees to make the payments about 10,000 only through account pay check or bank draft or other electronic mode. Copy of these instructions were verified by him. He had also taken a management representation that the net payment in cash to any person did not exceed 10,000. Therefore, he submitted that he had taken a reasonable professional care and on the basis of test check, nothing came to his attention to warrant a reporting of violation of section 48.3. What do you think will be the case over here? So, if you look the contention of the Director of Income Tax Investigation, he said as a part of the post-search inquiries, data from the billing software were analyzed and the violation was to the tune of 30 crore. In order to verify the findings from the digital data, some of the customers whose whereabouts were available from the computer records were contacted and the statements were recorded under oath. These customers admitted under the oath that they had sold some old gold and received the amounts all in cash in more than 10,000. The fact which emerges from the inquiry is that PQR Jewelers purchased old gold and made the payment for these purchases in cash more than 10,000. Though the audit report has a specific clause 21D concerning the 48.3, it was not properly filled up and the auditor failed to highlight the extensive violation of 48.3. And based on the tax audit guidance note issued by ICAI, which state that there may be practical difficulties in verifying whether each payment is made through the account pay check or bank draft or ECS, where the reporting has been done on the basis of a certificate of the assessee, the fact has to be reported as an observation in para 3 form 3CA or 3CB that it is not possible for the CA to verify the payment in excess of 10,000 otherwise than through account pay check or bank draft or electronic mode. However, in this case, the tax auditor has mentioned yes in response to the statement under the clause 21D on whether the expenditure covered under 48.3 were made by only account pay check or bank draft. And as per the guidance note, for the purpose of furnishing the required particulars, the tax auditor should have obtained the list of all cash payments in respect of expenditure more than 10,000 made by the assessee, which should include the list of payments exempted in 6DD along with the reasons. The list should have been verified by the tax auditor with the books of accounts in order to ascertain whether the conditions for specific exemption are satisfied. Details of payment which do not satisfy the above conditions should have been stated under this clause. He should have made the use of the audit tools which are available to find out the payments expeditiously and accurately where the data is voluminous. He has also made a reference to the CBDT circular of 1984 which clarifies that for the purpose of tax audit, a proper audit is for tax purposes would ensure that the books of accounts are properly maintained. They faithfully reflect the income of the taxpayer and he correctly makes the claim for the deduction. The audit would also help in preventing the fraudulent practices and facilitates the administration of tax laws by proper presentation of the accounts before the tax authorities, thereby saving the time of the assessing officer. Time of the AOs therefore could be utilized for attending to more investigational aspects. And in this case, given the massive scale of violation of 48.3, the CA has not exercised the reasonable diligence before offering the remarks and the audit was not carried out as per the guidance note of the ICAI. So what do you think? Whether the CA has done correctly is audit or not? Or can he just rely on the management representation? Yes. He has not exercised the diligence? Yes, right? So in this particular case, if you look at it, the CA has merely relied on the management. Even if he has done the test check, he should make a reference of that. He has not made any referencing for that. Secondly, see, there are audit tools available. He can just, look at the bank transactions and look at the party's account and see, considering that he's a jeweler, there could have been the possibility that, there are a lot of cash payments. Just performing the test check is not acceptable because payments can be identified by the chartered accountant if he had, looked into it properly. So, in this case, he is guilty of professional misconduct as per clause 7 and 8 of the part 1 of second schedule. Right? Because what does clause 7 says? The CA shall be deemed to be guilty of a professional misconduct if he does not exercise due diligence or is grossly negligent. Clause 8 says a chartered accountant in practice shall be deemed to be guilty of professional misconduct where he fails to obtain the sufficient information which is necessary for the expression of an opinion or its exceptions are sufficiently material to negate the expression of opinion. Right? So you have to correctly write in the examination the correct referencing to the professional ethics, right? Which clause that you are referring to. Okay? Yes, any question, any doubt? Is this clear? So even though you have to follow the concept of materiality, sampling, which are normally available for any other audit, but you have to also be aware about that in certain kind of businesses if the cash transactions can be more, in those cases you have to use your judgment that you cannot just you rely on the sampling in case of the cash expenses, right? So you have to take into consideration all of these points. Is this clear? Any questions, any other doubt? So the even when you are doing it, you have to maintain proper explanations, working papers should be maintained, on decisions on which you are relying should be maintained, even if you are doing the audit sampling as per SA 530. Right? The extent of check undertaken, how you have designed the audit program need to be mentioned. Right? So all of that, your working papers will form an important part for saving you on these particular aspects. Okay? Okay, let's look at the next one. Case study 3. Now here, XYZ and Company is a firm engaged in developing, operating and maintaining a highway project filed its return for AY 1617 on 30th September 16, claiming the deduction under ATIA on the basis of Form 10 CCB issued by a CA. In August 2017, it came to the notice of CA that the 10-year period for which the company had been eligible to claim the deduction and had in fact claimed the deduction had expired in AY 1516. The CA withdrew the audit report in Form 10 CCB and advised the firm to file a revised return under 139 file. At that point of time, the time limit for filing a revised return was 1 year from the end of the relevant assessment year, that is up till 31st March 18. The firm filed the revised return on September 17. The AO completed the assessment on the basis of revised return and issued the assessment on order on 1st March 2019. Now, the CA contended that as soon as he came to know about the error, he withdrew his report in Form 10 CCB and informed the assessee accordingly. The assessee filed a revised return withdrawing the claim of ICAI. He also informed the Commissioner of Income Tax about the same in March 19 at the first available opportunity, since he was neither the tax auditor nor was he representing the assessee before the tax authorities. He added that the AO had completed the assessment on the basis of the revised return. And according to him, his report in Form 10 CCB was neither the subject matter at the time of assessment nor at the time of penalty proceedings, right? So, here if you look at, the claim was made by the assessee in the original return as per 10 CCB. Then the CA advised them that there is an error and they withdrew the report and also assessee revised it. So whether the CA is guilty of professional misconduct as per clause 7 of part 1 of second schedule, the answer is no. Although CA should exercise the due care while issuing the audit report, but if there is some error, he has withdrawn it and he has immediately brought this to the notice of the assessee also. So in this particular case, he is not guilty of any professional misconduct. So are you seeing the difference that brings in respect of this? Okay. Let's look at the next case study. Next is Alpha Packaging Services located in Guwahati has been claiming deduction under ICAI since 2016-17 on the ground that it is engaged in manufacture or production of an eligible article or thing. A survey conducted on the company followed by a scrutiny showed that the company was merely involved in packaging the washing powder of a leading brand Turf obtained from Unilever Limited and giving the same back to them. The tax audit report as well as the report in Form 10 CCB for claiming the deduction under ICAI was issued by the same CA. A show cause notice was issued by the ACIT to the CA stating that his company got undue relief under the ICAI for the last 7 years on the basis of this report in Form 10 CCB to the effect that the concern was involved in manufacturing or production of the article or thing. Now, the ACIT contended that the report in 10 CCB is not correct since the company was not involved in manufacturing or production. The company was only packaging the washing powder that was given to it by the LMN Limited. It was not involved in manufacturing of any pouch, cover, sachet, which was independently sellable as a product in market. The company is also not a new undertaking because it had not taken over a proprietary concern and hired the plant and machinery of the proprietary concern. So it was not even a new undertaking. It was just old business started as a new. Hence, it did not satisfy the condition of ICAI. Now, the submission of the CA is the report in the Form 10 CCB was only a declaration, not a certificate. The ACIT said, no, this is not acceptable as 10 CCB is a declaration by a CA that the undertaking satisfies the condition for the claim of deduction. Amount claimed as deduction meet the conditions. The CA said reliance on the certificate of the Directorate of Industry Assam. ACIT's counter is that the activity which amounts to manufacture or production is different under each act. Now, this may amount to manufacturing by the director according to the certificate of Directorate of Industry of Assam. But this is not manufacturing as per the Income Tax Act. The CA which is issuing the Form 10 CCB, if he relies on some other certificate under other act, that does not tantamount that it will also amount to manufacture under the Income Tax Act, with the definition for which is given under 229B. He relied on the Supreme Court ruling in case of Aryan tiles and marbles, wherein it was held that when the marble blocks are cut into slabs and there is an activity of polishing and conversion of block into the polished tiles, the slabs which are produced are manufacturing, is a manufacturing activity because a new product has emerged. So the ACID said even according to the Supreme Court ruling, the condition to be fulfilled is that there has to be a new commodity coming into existence. In this case, the washing powder remains a washing powder. It's just a packaging being done. The original product and the end product remains the same. No new commodity emerges as a result of packaging. When the CA's contention was the proprietary business which was taken over by the company with all assets and liability except the plant and machinery pertaining to the old units. The plant and machinery was not transferred to the company but was given on hire to it, and for using these machines, the payment of hire charges was also paid and was also debited to B&M. So the company has not violated any condition of undertaking. The ACID said the assessee is not owning any plant and machinery. The assets hired by the assessee amounted to transfer, and thus the company was not entitled to ATI. Now, what is the conclusion over here? Now here, the question relates to the whether it was manufacturing. First of all, now the definition of manufacturing was inserted with effect from 1/4/2009. And the question here relates to the period prior to the definition of manufacturing under the Income Tax Act. Now, though packaging or repackaging is not manufacturing, removing the dust, grinding can be treated as a manufacturing activity, because in that case, removing the dust and grinding makes the product alter, right, and commercially different from its original form. Now, this conclusion is emerging on the basis of court ruling in the excise law and not under the tax law, right? Certain tribunal and High Court ruling have held that in order to constitute an industrial undertaking under 80IB, the industrial undertaking need not necessarily own its plant and machinery. It can take it on hire and can still qualify as an industrial unit. Now, considering the rationale emerging from the court decision, whether the activity of packaging constitutes manufacturing, number one, and whether if you don't own the plant and machinery yourself and hire it, can you still qualify as an undertaking? The benefit of doubt can be extended to the CA because he has relied on certain judgments and he is not guilty of professional misconduct. Sorry. Yeah. So he's not guilty of any professional misconduct because, there are different viewpoints just. However, in the current context, now that we have the definition of the manufacturer, this was the facts of the case prior to the definition of manufacturer under the Income Tax Act. So basis that, it can be said that since there was no definition based on different rulings, the different viewpoints can emerge. Now, since we have the definition under the Income Tax Act, the chartered accountant giving a declaration on Form 10 CCB has to ensure that the activity carried on by assessee amounts to manufacture as per 229B. He may rely on judicial decisions, but that should be on 229B and not some excise law or something else. Only when there is a similar definition in the law, he can rely. So here, making the product commercially marketable, which was one of the basis for conclusion in this facts of the case, is not covered as per the definition of manufacture under 229BA now. So if you look at the case at this point in time, it will be a violation. Secondly, the taking over all the assets and liability of the sole proprietary concern except the plant and machinery, and then separately hiring the plant and machinery just to claim the deduction under ATIA can be viewed as a tax avoidance measure. This may be viewed as an impermissible avoidance arrangement entered into just to obtain the tax advantage, and the GAR can be attracted if the tax benefit is more than 10 crore. So the CA, before issuing 10 CCB, has to satisfy the conditions of ATIE before issuing the audit report. Clear? Hiring plant and machinery be treated as transfer. Hiring plant and machinery will not be treated as transfer, but looking at the facts of the case, in case, it is the way it is designed, It may be treated as an tax avoidance arrangement. Then why they have not transferred the plant and machinery and just taken it on hire? All the other assets are transferred. So in that case, based on GAR, this can be regarded as transfer. Okay. Last one. The Income Tax Department collected documents from X Bank which revealed that Y Travels and Consultancy Services has remitted substantial amounts abroad. Documents collected include Form 15CB issued by CA, list of passengers, copy of their passport, state of travel, invoice raised by the foreign party. On inquiring from the passengers and verifying their passports, it is found that they did not travel abroad during the dates mentioned in the documents. Further, the passengers denied any sort of transaction with Y Travels. The department therefore concluded that the amounts were remitted abroad on the basis of false invoice and for wrong reasons and leading to FEMA violations, and 15CB issued by CA facilitated such violations. During the 6-month period in question, the CA had issued 80 certificates in Form 15CB, approximately involving remittances of more than 25 crores in the favor of Y Travel. Now, the CA submitted that he has issued the 15CB based on invoices produced by the company, verifying the KYC document of the signatory to the invoices. He submitted that since he was not the stat auditor, he did not examine the books of accounts before the issue of Form 15CB or conduct any due diligence of its business activity. He has charged rupees 2000 per certificate. Mostly the fees was collected in cash. Some part of the fee was credited to his bank account. Now, in this case, whether the CA is guilty of misconduct. So, Form 3CB is tax audit report, right? Where you examine these agreements between the remitter and the beneficiary requiring, like the entire tax audit thing. But if you look at Form 15CB, 15CB is just a remittance certificate where you just look into the contract, where you look into the invoices and you examine whether there is an agreement between the remitter and the beneficiary requiring the remittance. Right? And basis that whether the TDS has been correctly deducted or not. In Form 15CB, the CA certifying the form undertakes that he has verified the agreement between the remitter and the beneficiary and has ascertained the proper nature of transaction and the proper TDS on this. Here, the CA is mentioning that he has only verified the KYC of signatory and the invoices. He has not only failed to justify as to how the verification of invoices can be considered as sufficient compliance for certifying the form, but he also failed to bring in any invoices on record. Thus, he has failed to provide any basis on which he has issued the Form 15CB. So, issuing Form 15CB requires you to examine the agreement, books of accounts and the invoices to arrive at the characterization of transaction and to determine the correct TDS rate. Since in this case he has failed to do, he is guilty of professional misconduct as per clause 7 and clause 8 of the part 1 of second schedule because he has failed to obtain the sufficient information and failed to exercise the due diligence in discharging his professional responsibility. Are we clear? Okay. So CA, while issuing any kind of reports, any kind of certificate, has to be very diligent in terms of what he is relying on, how he is arriving at his opinion. He has to maintain proper working papers. He has to obtain all the invoices. He has to obtain all the agreement copies. Look at the books of accounts, even in a certificate like Form 15CB. And he has to mention those correctly in case, he does not have access to these documents. He should not, just be subjectized to the client's pressure in terms of it. Okay. Fine. So that's all for the tax audit chapter. And we close over here. In case you have any questions, we can take it up. Otherwise, we can close the session. Yes. Okay. So if there are no questions, I think we can close the session. Yes, you need to revise it properly, specifically the ethical requirements. Okay. Okay, thank you so much. We can close the session. Yes.